Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. This is a Perspectives broadcast. I'm Jeff Bernier. You know, a few weeks ago, I was talking with a client who asked a question I've heard dozens of times over the years. It goes something like this. Jeff, am I missing out by not investing in the current, quote, hot stock? You know, the specific company changes over time. A few years ago, it was Tesla. Before that, it was probably Amazon, maybe Google. Today, it seems to be NVIDIA. And increasingly, it's private companies that are going IPO, like SpaceX. The underlying question, though, never really changes. Should I own the next big winner? It's a great question because it gets at one of the most difficult challenges investors face. How do we participate in innovation without getting caught up in speculation? How do we benefit from human progress without overpaying for a story? And perhaps, most importantly, what's the difference between a great company and a great investment? Today, I want to explore what history teaches us about IPOs, market winners, artificial intelligence, and why some of the most successful companies in history have produced surprisingly disappointing outcomes for investors. You know, as human beings, we're naturally drawn to success. We admire excellence. We celebrate achievement, and we tend to assume that recent success will continue. A psychologist called this extrapolation. Investors just call it common sense. You know, if a company's winning today, surely it will continue winning tomorrow. If a stock has grown up dramatically, surely it must be doing something right. The problem is that investing isn't about identifying what's happening today. It's about understanding what is already reflected in today's price. And that's where things become much more difficult. Let's start with IPOs. You know, there's something exciting about investing in initial public offerings. A private company becomes available to the public investors. The media coverage is everywhere. The story is compelling, and investors feel like they're getting access to the future. Companies like Uber and Lyft and Zoom, Pinterest, Beyond Meat, you know, every few years has its own list. And every few years, it tells a similar story. This company is different. And maybe it is, but that doesn't necessarily make it a good investment. Researchers a few years ago at Dimensional Fund Advisors studied more than 6,300 U.S. IPOs between 1991 and 2018. What they found surprised many investors. As a group, IPOs generally underperform the broader stock market after becoming public. The hypothetical IPO portfolio earned approximately 6.9% annually compared to about 9% for the Russell 3000 index. So the companies were exciting. The investments were often less exciting. Why? Because investors weren't simply buying businesses. They were buying expectations. And those expectations were frequently too optimistic. Let's think about SpaceX for a moment, which obviously is all over the news with the recent historical IPO. You know, if there's a company that captures investors' attention and imagination today, it might be SpaceX. You know, what could be more exciting than reusable rockets, Starlink, satellite communications, national security applications, and potentially a completely new space economy? You know, the company is remarkable. The technology is remarkable. And frankly, you know, maybe the optimism may be justified. But notice something. The most important investment question isn't, will SpaceX be successful? The most important question is, how successful does SpaceX need to be to justify today's valuation? And that's a very different question. You know, one of the things I've learned from working with Larry Swedroe over the years is that investors often confuse a transformative technology with a transformative investment. You know, history suggests they're not necessarily the same thing. Larry recently highlighted the work of financial historian Edward Chancellor, who studies speculative booms throughout history. And one of Chancellor's observations is both fascinating and humbling. Some of the most important technologies in history created enormous benefits for society, while producing disappointing outcomes for many of its investors who funded them. Take the railroads. Railroads transformed America. They connected cities. They created national markets. They accelerated industrialization. Frankly, they changed the world. Yet many railroad investors were wiped out during the Panic of 1873. So while society won big time by the innovation, many shareholders lost. The same thing happened during the telecom boom of the late 1990s. Companies spent hundreds of billions laying fiber optic cable around the globe. The internet absolutely fulfilled its promise. But many of the companies that built the infrastructure eventually went bankrupt. So who benefited? Well, the companies that later used the infrastructure. Companies like Amazon and Google, Netflix, Facebook. So while the builders often struggled, the users often prospered. History has a sense of irony, and this is why the current AI boom is so fascinating. Artificial intelligence may absolutely change the world. In fact, I think it probably will have a significant impact. But history suggests we should be careful about assuming that the company spending the most money today will necessarily produce the best investment outcomes tomorrow. According to Chancellor's framework, when an industry begins earning extraordinary returns, capital floods in. Competitors arrive, investment surges, capacity expands, and eventually excess capacity develops, and then returns decline. The pattern has repeated throughout history. Railroads, telecom, the internet, and perhaps now artificial intelligence. So the technology succeeds, the investment outcomes become much more complicated. This brings us to NVIDIA. Let me be clear. This is not an argument against NVIDIA. NVIDIA may continue to dominate. Artificial intelligence may become even more important than investors currently expect. Both can be true. The challenge is the stock price already reflects enormous expectations. And as Larry often reminds investors, what matters isn't whether growth occurs. What matters is the difference between expected growth and actual growth. Because markets don't reward growth, market rewards growth that exceeds expectations. And that's much, much harder to forecast. One of Larry's recent articles highlights an important finding from decades of academic research. Investors often assume that companies with extraordinary earnings growth will continue growing at extraordinary rates. History, however, suggests otherwise. Abnormal earnings growth tends to revert towards normal levels much faster than investors expect. Abnormal earnings growth tends to revert towards normal levels much faster than investors expect. In fact, studies by Eugene Fama and Ken French found that profitability tends to mean revert at surprisingly rapid paces. Competition does matter. Innovation spreads. Advantages erode. Markets adapt. As investors, we consistently underestimate these forces, which means we consistently overestimate how long extraordinary growth can persist. One of my favorite charts from Dimensional Fund Advisors tracks the 10 largest companies in America through time. And the lesson is remarkable. In 1980, 6 of the 10 largest companies were energy companies. At the time, that probably seemed completely logical. Yet none of those companies remain among the top 10 today. History isn't telling us today's leaders fail. It's reminding us how difficult it is to predict who tomorrow's leaders will be. Every generation believes it's identified permanent winners, and every generation is eventually surprised. Now let's consider some research I've talked about before that's really the most surprising finding at all. Professor Hendrik Bissenbinder examined nearly 100 years of stock market history, almost 30,000 individual stocks publicly traded. What he found was astonishing. Only 41% of stocks outperformed Treasury bills over their lifetimes. Let me say that again. Of these 30,000 companies that went public and were publicly traded over this period of time, only 41% of them beat cash over their lifetimes. Nearly 60% of them failed to beat cash. So most stocks are not exceptional investments. A small minority create the overwhelming majority of wealth. In fact, only about 3.7% of the companies generated all the stock market net wealth creation over the past century. Think about that. Less than 4%. Those are incredibly long odds for stock pickers. People often look at NVIDIA and ask, why didn't I buy it? But that's the wrong question. The right question is, could I have identified NVIDIA before it became NVIDIA? Could I have identified Amazon before it became Amazon? Apple before it became Apple? Microsoft before it became Microsoft? That's the challenge. These winners are obvious in hindsight. They're rarely obvious beforehand. This is where diversification enters the story. Many investors view diversification as settling, as giving up, as admitting they can't pick the winners. I view it a little differently. To me, diversification is an expression in humility. It's an acknowledgement that innovation is real. Human ingenuity is real. Future winners will emerge, but predicting them in advance is extraordinarily difficult. Diversification allows us to participate in innovation without requiring us to forecast exactly where it will occur. It allows us to own tomorrow's winners before we know their names. Not because we're pessimistic, because we're realistic. Let me leave you with one final thought. The railroads did change the world. The internet changed the world. Artificial intelligence will likely change the world in some ways. The question investors face is not whether these technologies matter. The question is who will ultimately capture the economic rewards. History suggests the answer is rarely obvious. As Larry often reminds us, investing success comes not from predicting growth, but from understanding the difference between expectations and outcomes. And because that difference is so difficult to forecast, diversification remains the most powerful idea in investing. It allows us to participate in human progress without requiring us to predict it. And in a world full of uncertainty, that may be one of the wisest investments we can make. Thanks for listening. Hope you found this helpful. I'm Jeff Bernier. You can check out past shows wherever you stream your podcast. Give us some feedback. Let us know what you think. If you'd like to reach me, you can email me at moneyandmeaning@tandemgrowth.com, or you can look us up professionally at our corporate website, tandemgrowth.com. Thanks and have a great day.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.